And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Check. And we're back. Hey, welcome back to the Real Investment Show. Yes, we are live after a week-long vacation, and yes, we are working through some technical difficulties. When our equipment goes to sleep for a week, it doesn't respond well to having to wake back up. Nobody wants to come back to work after vacation, right? So anyway, lots of stuff happened while I was gone. The good news is the markets did not crash, which is I was accused of doing, that every time I leave, the market crashes. Well, that didn't occur. Actually, the markets hit all-time highs while I was gone and just kept making new all-time highs. We'll get into all the technical backdrop today. There is some stuff going on worth paying attention to. But outside of that, while I was gone, the big, beautiful bill passed, and as expected, not easily. It went to the Senate, changes were made, as we talked about here on the show. The reconciliation process requires it to go back to the House for a vote on the changes that the Senate made. There was a bit of filibustering and things that went on, and negotiations and backroom deals and everything else to try to get the bill finally passed, but it did pass. So now the one big beautiful bill is now law. It's been signed into law by the president. And of course, this has got a lot of people divided on the impacts of the bill. The good news is that it makes permanent the 2017 Tax Cuts and Job Act. So what that means is, and again, while a lot of people want to debate the good or the bad about the tax cuts, it means that there's not a tax increase. The tax rates don't change. There wasn't an additional cut to taxes, and they are just the way they've been since 2017 when we passed that Tax Cut and Jobs Act. So again, it doesn't change anything in terms of tax collection, revenue collection, anything like that, but it does provide some certainty now that there won't be tax increases. So that was a relief to the markets for a big part, because that has a big impact on corporate profitability and earnings. Of course, there's concern about the debt and the deficits. We can get into the negotiations of that. Some changes to Medicare and Medicaid that has people very divided right now. Again, adding a work requirement and some other things to Medicare has a lot of people up in arms about that. But again, those are the debatable points. The question is whether or not this leads to better economic prosperity and down the road. And that's going to be the big question. Is that will this change the dynamic of debts and deficits and economic growth and those type of things, or is this just another spending bill like we've seen every time previously? Now we can get into that, and I'm going to have an article out here the next week or so talking about the deficit and kind of the trajectory of that. And of course, there's a lot of things that are going to occur. One of the interesting things that isn't included in a lot of the debates, right? So we've heard a lot about this big, beautiful bill. It's going to add all this debt and deficit, and on the CBO projections is just off to the moon. What's interesting is none of that includes the tariff revenue that we've already collected. We've already collected in excess of $100 billion in a quarter in terms of new revenue that we didn't have before. So take $100 billion in revenue, multiply it by 4 quarters, that's $400 billion a year. Over 10 years, that's $4 trillion in additional revenue that's not included in any of the CBO projections, right? So again, these are the things, and again, what also isn't included is better economic growth because of artificial intelligence and things that we're doing in that field, increased productivity. None of that's included in these projections. It all assumes that everything that is as of today remains that way for 10 years. It also doesn't assume that interest rates will ever come down again. So if interest rates fall, there's $500 billion a year and basically interest rate expenses that we won't pay, right? So additional decline in the amount of debt or deficit. So again, you've got to take a lot of these headlines that you get and put them in perspective. as to what they mean, and also who's providing these, what's their history of doing this type of stuff. We've been through that data before. But again, what we want to know is, as investors, right? So again, we may have our personal views on the big beautiful bill, what it means for me personally, tax rates, etc. But let's talk about the markets right now, because this is what the markets want to know, is how does it impact earnings growth? And the one thing this big beautiful bill does is that it ensures that profitability and earnings growth right now won't be affected by higher taxes. So the market liked that. That's why the market rallied as we passed that bill. Outside of that, of course, terrible tragedy with the floods here in Texas. That's ongoing right now. Just an immense amount of death and destruction that's happening in that. And our hearts go out to all the families, particularly families here in Houston where we live that had children at the camp. It's just a terrible tragedy. So again, our hearts, thoughts, prayers all go out to you. If you're listening to the show today, know of anybody involved in this situation, we certainly express our sympathies and heartfelt prayers. So again, just saying that. All right, let's talk about what you need to know before the bell this morning. Markets, again, like I said, they didn't crash while I was gone, which was a good reason. But while we're back on a MACD buy signal, which has been encouraging right now, we are pushing more extreme levels of overbought. And if you read this weekend's newsletter, and I'll show you some charts here in a few minutes, greed in terms of investor positioning is now at extreme greed levels. The technical composite that we run, 13 composite indicators on a weekly basis, is back to more extreme overbought conditions. And really, we're seeing those overbought conditions really across the board. Lots of retail speculation. We'll talk about that this morning here on the show. Whenever we get up to these levels, this is where you're set up for some type of event to cause a short-term correction or consolidation, to work off that overbought condition. Now, what that is and what occurs from that, who knows? Now, right now, there's some concern because President Trump announced yesterday that he will delay the tariffs until August the 1st. So they were supposed to restart today. A lot of concern that on July the 9th, all these tariffs would kick back in. If they hadn't had a deal, then the original tariff would come back in. The 90-day pause was over as of July the 9th. Well, he's now postponed that to August the 1st. So that gave the markets a little bit of breather room here. But again, he said he's sending out letters to 12 countries today talking about if they don't get a tariff deal done, their tariffs are going up. He's also applying a 10% tariff to any countries that join the non-friendly to America BRIC organizations that are kind of working against anti-American interests, according to the president. They will have an additional 10%. Seen before with tariffs has been a consistent kind of, oh, here they are, no they're not, here they are, no they're not. And markets are kind of getting to the point to where they're expecting that President Trump will kind of back off on these tariffs. They sent, kind of the stick and carrot thing we talked about before. He'll back off of this. So futures aren't broadly negative. The S&P is down about 20 points here this morning. But again, even without that announcement, the markets are very overdue here for a bit of a pullback. We're very deviated from the 50 and the 200-day moving average. We're very overbought. So again, this isn't a good place to chase markets here. Expect a little bit of a pullback here. This is a great point right now to maybe rebalance some risk in your portfolio. Look to take some profits. If you've had some big gains here in this recent move, take a little bit of profits, reduce back to target weights, those type of things. Just small actions to hedge your portfolio here a bit over the next week or two, particularly as we start to head into earnings season. Earnings starts next Friday with JP Morgan, BlackRock, Wells Fargo. They'll announce earnings next week. So again, the market's kind of gearing up for that. Also, the blackout window is kind of in full effect right now as well. So there's some potential here for a little bit of volatility over the next week or so just be careful. But that's what you need to know before the bell this morning. We'll come back to a lot of stuff to get into, so don't go away. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. And again, lots of stuff's happened over the last week. I'm going to try to just kind of hit some highlights, etc. So many things happened. But one of the things that, we've had to kind of the wind beneath our wings, the tailwind, kind of whatever you want to call it, over the last month and a half, really 2 months, essentially since the April lows, was an extreme amount of negative sentiment, right? So positioning was very negative, sentiment was very negative, attitudes by retail investors were negative, even though they were acting bullishly. But we've just seen a lot of this kind of very negative sentiment, and as we talked about before, that provides that lift to stocks, because as stocks start to go up, you start dragging more and more people back into the markets, and now we've kind of got to the point we've sucked pretty much everybody back into the markets here. So again, that's why we want to be just a tad cautious here, more than anything else, just because we've got to the point that a lot of that support for the market has now been reversed. And, one of those things, and again, so we've actually, just a quick announcement too, we've reformatted our weekly newsletter. So that goes out, we've made it a little bit shorter, a little bit more condensed, more readable in terms of just really kind of focusing on market dynamics, et cetera. So if you haven't checked out the Bull Bear Report, go subscribe at our website. realinvestmentadvice.com. We email it out every Saturday morning. You can also get it on our Substack account at Lance Roberts. So either way, subscribe there and you'll get our weekend newsletter. It goes out every Saturday morning, kind of reviews the markets and has some technical things in there that we only produce in that newsletter. One of those is this graphic, which kind of summarizes the major markets and sectors. So it covers international emerging markets, the sectors of the index, bonds, and small caps, mid caps, and looks at their performance on a year-to-date basis. And it looks at it in terms of relative performance on a year-to-date basis. So how are these doing compared to the S&P 500? Are they leading? Are they lagging, et cetera? Now, the lower left-hand corner is what you want you to pay attention to, which is how many of these markets and sectors are at extreme overbought conditions. And right now, we're back to more extreme overbought conditions, not only on the market itself, but on a lot of the individual sectors themselves as well. So again, when you get the most of the market back to very overbought conditions, that's typically a good time just to exercise a bit of caution. This does not mean the markets are about to crash. This does not mean you're about to have another April swoon of 20%. I'm not saying that at all. That's not what this means. It just means that a lot of the price action that has occurred as of late has brought in all the buyers, and everybody that's going to buy has pretty much bought at this point. So again, this is kind of that contrarian indication where we step back and we just kind of reassess our positioning from a contrarian point of view, because again, most of the upside is likely kind of already built into the markets right now. So kind of all the good news is there. We also see this from the standpoint of looking at our this is our technical gauge, and this technical gauge, I've shown you this before, runs from 0 to 100 and is comprised of 13 different indicators. Now, these are weekly indicators, so it's much slower to move. And as we talked about back on April the 7th, we wrote that article called Hope and the Fear. That technical gauge had gotten down to 771. That's as low as it's been even during the pandemic, and it's only been lower really, during the financial crisis and the dot-com crisis. But it was extremely oversold. So you had sucked out all of that bullish positioning in the markets, right? And it gotten markets to extreme oversold levels. So now we're back. We closed last weekend at 85.33. So again, we're up in more extreme technical levels of overbought. Now, doesn't mean the market, again, this does not mean the markets are going to crash. It just means that a lot of that price action of the market has already been built in. So this is a really good point to kind of just reassess things that you've been doing. And we see the same thing, and I'm going to dig into a little bit more of this in the next segment about what retail investors are doing right now, because it's absolutely amazing kind of what is going on with the retail investor, considering kind of the backdrop economically, liquidity-wise, et cetera. It's pretty amazing what retail investors are doing. But this is the Fear Greed Index. Now, this is different than the CNN Fear Greed Index, which basically uses the S&P to measure the S&P. This has no factor of the S&P in it. This is all the things that surround how the S&P works. So this is sentiment, bullish and bearish sentiment. It's positioning, it's options, it's volatility, it's all the underlying drivers of the markets. And right now, we're back to over 80. We're at 83, 84 as of last weekend. That's a very high level. Again, it has been higher previously. It's gotten close to 100 at times. And when you get closer to 100, that's typically really close to a market peak. But we're getting back into more extreme greed levels, which, again, just from a position of being a bit cautious, kind of start looking at your portfolio, maybe hedge some risk, look on to take, raise a little bit of cash, kind of whatever it is. Now, right now we're carrying some excess cash. So, we're hoping for a pullback here that we can put some more cash to work. Again, there's nothing wrong with the markets. The markets have had a very strong first half of the year, surprisingly, despite, all that volatility that we had in April. It's behind us now. And through the first half of the year, the market was up 7% for the year. So it's not a bad return year. Annualized out, that's a 14% return year. When markets have typically had a strong first half, the second half tends to be also very strong, on average about 14%. So there's no reason to be overly bearish here, despite all these other headlines: tariffs, debts, deficits, the big beautiful bill, whatever it is, the dollar. There's no reason to be negative right now, at least from a market perspective. Lots of things to worry about, and I'm not saying don't worry about these things at all. I'm not saying you shouldn't worry about the debts and the deficits. They do have an impact. but they don't affect the markets today. And, I get a lot of, kind of tweets and emails and things about different stuff. And it was interesting because Friday was the employment report, which came in much better than expected, 147,000 jobs. And last month's jobs, I was wrong. I expected that last month, the May jobs report would be revised down closer to 100. It wasn't. It was actually revised up a bit. So, the jobs numbers continue to be fairly strong. Now, of course, the immediate response is it's all hogwash. You can't trust those government numbers, and they're all wrong. They're all manipulated, et cetera. And maybe. I mean, you can make an argument for that. But what's important is from an investing standpoint, and this is the thing we've got to remember. And look, I used to be the same way. Like, those numbers, numbers are all fudged, right? It took me a long time to understand that the markets don't care what I think, right? The markets only care about the data. The data right now, whether you agree with it or not, says the employment market's doing fine. Slowing, definitely some signs of weakness in the employment report, right? So we're definitely slowing down. We only did 147,000 jobs, right? We're not knocking the cover off the ball here. But that's all the market cares about, is that number. Same thing with inflation. Market doesn't care about what your personal views on inflation are. The market cares about what that inflation number is, because they take that number and say, okay, what's the Fed going to do? So the one thing we have to remember as investors, when you see all these bearish headlines and kind of prognostications for the end of the world as we know it, is, does the market care about those views? So, if you hear somebody chattering on a YouTube channel somewhere or writing some article that says, a 50% market crash is coming, that may well be the case. But as we talked about before, if you're going to make a prognostication about a 50% market correction, you've got to say, when is it going to happen? Why is it going to happen? And what actions do you need to take during that process? Because it'll eventually end. And and the problem with a lot of people predicting 50% market corrections, they go, 50% market correction is coming, but they don't tell you when. And they don't tell you what to do beforehand. They don't tell you what to do afterwards, because they end. And, there's a lot of people who have been predicting 50% market corrections for the last 15 years. And even when you have a 35% correction, they're still predicting another 50% correction. Right? They don't ever tell you, it's like, hey, we've had a correction, time to get back in. And the markets are going to go up until we get set up for the next correction. And we're going to have a correction. Look, we are going to have, at some point in the future, and I don't know when, you're going to have a 30, 40, 50% correction. It's going to happen. Right? But it's going to require certain things to occur that we're going to see well beforehand. Just like going to the dot-com crash, just like going to the financial crisis, clear evidence that things were breaking well before the market realized it, right? And we're going to help you through that process, but we don't have any of that stuff right now. All right, I want to talk about investor greed when we come back, because retail investors have just gone off the chain as of late. I'm going to show you some stuff about it when we come back from the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the health care insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I remember in school those history stories about the late 1800s, and now Gen Z kids are now calling the 90s the late 1900s.
The Real Investment Show podcast.
And I feel like I just drank from the wrong grail in Indiana Jones.
Same show, your schedule.
I was talking to my daughter a few weeks ago, and I said something that she didn't agree with. And she goes, "Dad, you're just getting old and not relevant anymore."
At realinvestmentadvice.com.
Not relevant.
You're not relevant.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Brent will have no hair left after this morning. It's only been a week, Brent. Has your dementia set in? Just don't know how to work all the controls? What's happening?
I suspect we lost power on the floor last week at some point. Came in here, no AC. I've got one dead monitor, and we're having skipping audio issues that I can't diagnose in the middle of the show.
Gotcha. So basically, you have completely failed at your job today.
I need a vacation from my vacation.
Yeah. We're just going to come back next week. Thank y'all for joining today.
You know, I probably could have done it all if the dadgum AC was working. Because it's like 80 degrees in here.
I know. But so you need coolness in order to make everything work.
I can't work under these conditions.
Oh my God, I've hired a snowflake.
More like a puddle.
All right.
Tomorrow will be a better day.
I need a mental health day. Anyway, sorry. Okay, back to work. It's just for the break. So just talking a little bit about last segment, markets are now back to extremely overbought conditions. That does not mean I just don't want anybody coming back. I was like, Lance, you said it was going to crash. I'm not saying it's going to crash. It does not mean that. But it does suggest you're going to get a bit of a correction here at some point. Could be 1 or 2 days, maybe 3 days. But we need a bit more of a consolidation correction process to work off some of that overbought condition to provide a good entry point for investing more capital. And, and again, we talked about this before. When you talk about corrections, people assume you mean lower prices. That is not a correction. That's what we think a correction is, but that's not what we mean in terms of investors or investing, I should say. We're not looking for markets to have a 15% pullback or a 10% pullback to some specific level and says, that's the entry point to put money to work. That's not what you should be looking for. What we're looking for is a better risk reward setup. And right now, because markets are very overbought and extended and deviated from means, that risk reward setup is not in your favor. You have more downside risk than you have upside potential from current levels. As we talked about before, the market could just grind sideways for a month, not go anywhere, and completely revert that and provide a better upside risk reward setup, even though the price is exactly the same as it is today. Then I know that doesn't make a lot of sense, but that's the way it works. Because we just wanted to allow these deviations and overbought conditions to reverse themselves somewhat so that we get a imbalance of buyers and sellers, and we want that imbalance to favor buyers versus sellers. Right now, the imbalance favors sellers. So we want to be careful of that. That's all that means. So again, don't extrapolate overbought conditions into lower prices. That happens often, right? But it doesn't mean that has to be the case. But one of the things that does kind of bother me a little bit, and again, it only bothers me from the standpoint that I don't understand it, is retail enthusiasm. I want to show you this chart. This chart is cumulative net retail purchases by calendar year in first half and second half. And I want you to notice two things about this. First of all, in 2025, we have now set a record of cumulative net retail purchases, $155 billion. But that's not the most interesting thing about this chart. What's the most interesting thing about this chart is look at what happened pre-2020. From 2014 through 2019, we were doing around $40, $50 billion in net purchases in the first half of the year. In 2020, we send checks to households and it explodes. And it's just remained elevated ever since. It's like we flipped the light switch in 2020 and said, okay, all you retail investors, y'all have never been in the markets for, time to get in right now. And they all jumped in. But this deviation in retail purchases is quite phenomenal. And two questions come out of this is, and I'm good with that, Brent. Two questions that come out of this analysis is, A, kind of where's all the money coming from, right? We hear about all these people that have, no money and they don't have any, kind of just struggling to make ends meet, and inflation, et cetera, is just terrible. But yet they're just throwing money at the stock market with really what seems to be reckless abandon. And I say that because we're seeing this in some of the most speculative areas of the markets. And, and that's what's really interesting. And if we kind of look at this, there's a lot of differences today between where we were in 2020 versus where we are in 2025. So, go back to 2020. I can understand the big jump sorry, I didn't hit my pause button. I can understand the big jump in retail buying in 2020. Why? Because you'd shut down the economy, right? You couldn't go bet on horses or, sporting events or anything else because everything was shuttered, right? So all of a sudden people downloaded the Robinhood app and they started speculating on stocks. And that's where we had the whole meme stock thing, et cetera. But in 2020, we were sending checks to households, giving people money to do stuff with, and they had nothing to do with it, so they went through it at the stock market. They were buying Bitcoin and meme stocks and everything else. I get it, right? There's nothing else to do. But you had 0% Fed funds rates. Treasury rates were 0.5%. You were doing $120 billion a month in QE. GDP growth was shooting higher after the second quarter because we opened the economy back up. Inflation was rising. Today, you've got even more speculative activity than you did then, but you have no checks or stimulus spending. All the payments have resumed, right? You got to pay your rent, got to pay your mortgage, etc. Fed funds rates are 4.3% of the mid. Treasury rates are 4.3%. You're actually reducing QE by $5 billion monthly. GDP growth is slowing. Inflation's coming back down. So the entire setup for this speculative, kind of frenzy in the market is entirely backwards to what it was in 2020. Yet, at the same time, the amount of speculation in the markets in terms of different aspects of the markets itself and kind of where investors are investing capital has just continued to surge. And here's a chart. This is call option volume on the S&P 500, which you can see how it was rising in 2012, 16, 18. It was creeping up, just rising kind of normally with the markets. And you kind of expect that. And then really in 2020, it just started accelerating and has just kept accelerating nonstop since then. In fact, there's just a abnormally large amount of call option volume in the markets right now. A lot of this is being driven by retail investors. And again, there's nothing wrong with that, but you have to just assume that there's a lot of people taking on a lot of excess risk. And if you take a look at the put call ratio, so that was just call option I showed you a second ago. So that was just call option volume. This is the differential between puts and calls. Right now, the put call volume ratio is down at very low levels, which means basically nobody's buying any puts to hedge their portfolio, which is typically about the time that you get a decent correction in the markets. And in fact, if you go back and kind of look at this chart, you can kind of see it, right? 2020, 2021, you're getting really low on put call ratios. And of course, you had 2022. You see really kind of January 25, you were back down to these levels. And of course, you had March and April. So whenever you have very low levels, when nobody's hedging risk and it's all risk on, that's a really good indication that you might want to be a little bit more cautious about your allocations, kind of across the board. But again, it's quite phenomenal. I mean, just looking back at history and looking at the amount of flows into equity ETFs, leveraged ETFs, just equity ETFs in general, right? Just the amount of flows into these assets is quite phenomenal. You've had $515 billion in equity fund flows. You've had $328 billion. This is one of the third biggest years that's just flowing into U.S. equities. And you've had $21 billion flowing into leveraged ETFs, which is some of the highest levels on records. Again, you don't see that outside of normal markets, but it just is it's just representative of the amount of kind of speculative excess that's going on in the markets. Again, there's nothing wrong with speculation, right? But the reason you want to pay attention to it is because this is that sign we were talking about in the last segment about investor greed. And we're now at levels that historically have been near short-term market peaks and corrections. And we've got to reverse that just a little bit. Again, doesn't mean a market crash, but it's certainly things worth considering in your portfolio. Kind of go sit down with your portfolio today and have a little bit of a conversation with it and say, you've had a really good run. Let's set you on the bench for a little bit. Reduce that back to target weight. Doesn't mean sell everything, right? Reduce things back to target. Losers, let those go out of your portfolio. It's not working for a reason. If it's not working in this market, gotta let it go. There's something else going on with it if it's not working in this market, because everything's working in this market. So again, just be a little cautious here. That's all I'm saying. All right, we'll come back. We're going to talk a little bit about a scam that's been going on. It's had a 300% increase just this year. We'll kind of get in and tell you what to watch out for. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, as you know, I spent last week, I went over to the UK to visit my son. He's living over there. He's doing fantastic. And, it's very interesting. Two things just real quick, just a note is, there's some comments that I see a lot about how unfair things are here in America. And, I don't get paid enough and I can't afford a house and I can't I can't save money because the cost of living is too high, et cetera, so forth and so on. And I don't have, I don't help my son at all. He requires no help and he wants no help at all. I mean, like literally my wife has to beg to buy him a pair of shoes because he just won't let her do it. And I appreciate the independence. He's 25 years old, and he went to Germany when he was 18, immigrated in by himself. He had no help from us, worked at Kentucky Fried Chicken while he did his immigration process. Took him 3 years. Finally became a legal resident of Germany. Then he moved to the UK, went to college there, got his engineering degree, and he's now got his first job with this company that he's building electrical panels. Now there's some other steps he has to go through. So right now he's making minimum wage, which is in the UK, it's about $12 an hour comparatively. And the reason I tell you this is because he's 25 and I didn't know any of this. I haven't helped him with anything that he's doing. He's done all this on his own, but he's 25. Him and a friend bought a house together, and they have a house to live in. And he saved $10,000 out of his salary because he lives very frugally and he pays attention to his money. He's opened up his own investment account and he's making that money grow. And again, I'm not helping him, but my point about that is that, there is a difference between cost of living and all these type of things, and I can't afford to do things and I can't save money versus the will to do it. And he's got a will to do it. And and he's doing very well for himself. And this is one of the key things that, we always talk about here on the show is like, you have to pay the toll early in life in order to live the way you want later in life. There's an old Dave Ramsey saying that he says, live like nobody else today so you can live like nobody else tomorrow. And that's a very good statement. And that's what he's in that process of working on. He's doing a very, very good job of it. So I'm proud of him. But anyway, so we were there to visit him, and we were hanging out for a few days, and my wife's trying to cater to him, and he just won't let her do it, and she's getting very frustrated at this point. But so we were there to celebrate Treason Day. And so on Friday, we went to we were in Bath, which is where the Roman baths are. And we were just kind of doing some window shopping, some things like that. And I saw this liquor store. And so I went inside this liquor store, and it's a very small kind of liquor store. They just sell a lot of local regional brands of liquor and those type of things. So I just was browsing to see what they had. And Brent, I need this picture for me. I posted this picture on X, but this was posted right in the middle of their store. It's a big sign. And this is why we haven't seen an impact of tariffs. This is just one example. And I talked to the shopkeeper for about a good part of an hour talking about, what's going on in the U.S. and how, and again, this is, when you're in Bath, it is just literally every bottom of every building is a retail store, restaurant, something like this. So, I was asking him about other store shops, et cetera, all around. He was like, yeah, we're all doing the same thing, which is they're basically eating the tariffs in order to ship product to the U.S. at the same cost. Because again, they have, for instance, I like flavored whiskey. I don't drink a lot, but if I do, on the rare occasion I do like a flavored whiskey. And so I was talking to him about the different flavors that they have and stuff like that. And because they have some very unique stuff. And we were, and the reason we were talking about this, I was like, and the reason they discount that is like, well, if I don't discount it, when you go back to the U.S., you'll just go buy Jack Daniels at a cheaper price than what I've got to sell it for you for the tariff. So we eat the tariff in order to compete so that you'll buy our products. And this is what I've been saying all along about tariffs is that, there's this expectation by the fact, the tariffs are coming and they're going to cause inflation, but yet it hasn't shown up yet because this is what's happening behind the scenes. Either customers say, I'm just not going to buy it because it's too expensive, or the producer's saying, I'll eat the tariff to send it on to you. And now we're hearing about this from Walmart and others as well. They're gonna have to absorb some of these tariffs in order to be the low-cost producer or provider of products. And this is why we haven't seen tariffs show up yet in the overall market. And we may see some tariff impact, but it's going to be a one-time event. Right. So once I raise the cost of a good, so let's say I bought a bottle of whiskey there and shipped it home and it was 10% higher than what I could buy from here. It's one time. If the tariff stays in place, that price doesn't change. In the course of a year, there's no inflation. So the inflation is only temporary that's caused by tariffs, if it even occurs. And what we're seeing so far is that we're not even see that occur yet because of what's happening kind of behind the scenes. So it was just interesting. Right? It was just kind of an interesting event that occurred. And again, as I talked more and more, and my wife's like, oh, can we go now? And I'm like, no, just hang on. Like, go shop somewhere. I'll be there in a minute. But yeah, the more we talked, it wasn't just him doing this. This was a large majority of the other shopkeepers in that whole area. We're doing the same thing because they've got to compete. So let's talk about something else. There's a lot of buying right now. And this is what I was saying before the break. I wanted to talk about this fraud that's going on at the moment. And there's a lot of buying of penny stocks at the moment by retail investors. Because, again, we're in this very speculative market right now. I throw money at the market. It goes up in price, and I make money, and everybody's happy. Well, we're seeing a big movement of that. About 50% of the entire volume of the market has been in penny stocks. These are stocks that are sub $5 in share price and do not have any institutional support because institutions can't buy stocks below $5 on average. So there's a lot of speculative action that occurs, and there's been a huge surge. I'm going to read from this article. This was in the Epoch Times. There's been a huge surge of criminals targeting stock investors in the United States in a ramp and dump stocks manipulation scheme via messaging apps and social media platforms. And this is from the FBI in a report they put out on July the 3rd, the day before Treason Day. In the scheme, investment clubs are promoted among potential targets. These clubs are often bots or fake accounts, and the promotional messaging directs victims to secure messaging apps where the group operates. So think about things like WhatsApp, TikTok, etc. I see a lot of this on TikTok, by the way. Scammers impersonate legitimate brokerage firms or well-known stock analysts to appear credible. Now, be careful with this because, look, nobody knows who I am, but I have about 100,000 followers on X. I have to fight almost every day impersonators that use my face, my layout on my website, take my post, repost those, and then try to direct people to a WhatsApp account or another account to, tell them, it's like, oh, buy this stock. That's not me. If it's not the verified account of @Lance Roberts on X, it ain't me. But there's a lot of those out there. So you got to be real careful. These bots and impersonators are everywhere. And they're promoting things like, @Lance Roberts says buy Bitcoin or whatever it is from this particular person or group or whatever. That's not me. I never make any stock recommendations on X. So if you ever see a post from me, or you think it's from me because it's my image and my likeness, etc., and I'm promoting for you to do something, it's not me. Don't do it. Make sure it's the verified account of @Lance Roberts. But here's how the scam works. What they do is they go out and they buy a very large block of some very small company, generally $100 million in market cap or less, very low volume in terms of trading. And they'll accumulate shares over a period of time at 50 cents, $1, whatever it is. And then once they have a large block of shares, they go out and they start promoting this. Oh, this stock's about to go through the roof. You got to buy this stock because of A, B, or C. And I've got inside information that this stock is about to get this major contract with whatever the scam is. And so they start getting people to buy it. And of course, it drives the price up. And then once they drive the price up, they start selling their shares. And then, of course, that crashes the stock price. You lose all your money. They make money, and that's how the scam works. And these things are very, very hard to catch. But there's been a 300% increase in these types of scams just this year, according to the FBI. So, be very careful with this. And, be very careful where you're getting your advice from. And again, if you're getting, messaged by somebody or you see some person on TikTok talking about, oh, I just made all this money trading this or that, be really careful with that type of stuff. Again, we have a tremendous amount of speculative frenzy in the markets right now because it just seems like it's a no-lose game. It's like going to Vegas and you just throw money on the blackjack table and you win every hand. It's great. But just be really careful that you don't get sucked into one of these scams. I've dealt with so many people over the years that have got scammed out of a majority of their wealth through things like this. And look, the scammers are very creative. They seem legit. Seems like you're talking to real people, real firms. Before you do anything, do your due diligence on the person, on whatever it is. And make sure you really understand what the risk is that you're getting into and make sure that you're not getting caught up in some type of scam. So anyway, have a great day. We'll be back tomorrow with John Penn, Two Dads on Money. Be right here in the morning. We'll see you back then.